let's get straight to our next management. Equitas Small Finance Bank, they reported a weakish set of numbers in the first quarter. The lender's latest earnings spotted some disappointing results, with profits down on a year-on-year basis. Net interest margins as well declined a little bit. But to understand what went on in the past quarter, what's the way ahead from here on, Mr. P.N. Vasudevan, the MD and CEO of the company, joins us on the show. Hi, Mr. Vasudevan. Good morning and thanks a lot for joining in. Let's get a couple of basic numbers out. I think you're guiding for growth of around 25%. But a couple of brokerage notes, they are suggesting that it could be a little less than that. Are you confident you can do 25%? Point number one. And also the loan mix is changing a little bit. There is a declining share to the MFI share. And that in turn could be, asking for lower yields. So what does it mean in terms of margins going ahead?
Yeah. Good morning. So on the advances growth, yes, in the beginning of the year, we have guided for a 25% growth for the year. First quarter has been at around 17-18%. For advances growth, we need also equivalent growth in the deposits. And on the deposit, we have been actually doing quite well. The first quarter saw a deposit growth of almost 33%. And the CASA after quite some time, we were able to actually hold on to the CASA levels for the first quarter compared to the last previous quarter. And our retail TD has done really well. Last year also that had done very well. And this year also, the first quarter, we had a TD growth almost at 50% over the previous year on year. So on the deposit side, we are very comfortable. And another very equally crucial thing is the CD ratio, which now we know is the talk of the town. And we are now at a level of around just under 87%, which is a very comforting level. And so, from a deposit CD ratio perspective, we are all ready for managing growth. Now, coming to the advances side, even though the first quarter was lower at about 17%, we should still be able to see the bank reaching that 25% guided growth for the full year. Because we have a range of products, and the first quarter is generally a seasonally weaker quarter. Subsequent quarters are generally better. And so we should still look at that 25% growth for the year to be delivered by the bank. Now you asked for the second question, which is on the NIM side.
Yes.
The effect of reduction of microfinance as a contribution of the total portfolio, and whether that will have an effect on the NIM and contract the NIM. The first quarter, we had about a 20 basis points drop in NIM. Almost 10 basis points was contributed by the CD ratio, which has been coming down over the last few quarters. But now we have reached a CD ratio at a very comfort level. So we should see the CD ratio being maintained from this quarter onwards around the same level. And so the 10 bips reduction of NIM because of that might not kind of repeat again. The second 10 bips reduction was largely contributed by the fact that microfinance contribution dipped to the overall portfolio. And there is some lot of effort in the system to try and see how do we make up for that. We have that MLAP, that's a micro loan against property, which is lending less than 7.5 lakh rupees against security, which is equally at the same level of NIM as microfinance. So there's been a more focus on that in the last 1 or 2 quarters. And going forward, we are hoping that might actually be able to fill up that gap of microfinance from a secured perspective and still yielding at similar levels of NIM.
So MFI? So, sir, MFI as a percentage of your portfolio, what is it and where do you see it stabilizing?
It's currently at 17%.
Yes.
And, over the rest of the year, it might drop down to anywhere around the 15% level. And because we plan to introduce our personal loan and credit card over the second half of the year, and the expectation is that the drop in microfinance will actually be largely taken up by personal loan and credit cards, which are generally at the similar NIM kind of contributory products. And then the MLAP, which I mentioned earlier, that should also help in terms of holding on to the NIM.
Personal loans and credit cards over the second half of this year, that should be high-yielding assets. But, the one thing that we try to understand from you is your decision to apply for a universal banking license. That it is in the offing is something that you can always monitor from the way your provisions have moved. In the first quarter itself, you've taken it up all the way up to 70%. Your net NPAs have come down as well. So when are you likely to apply? When are you likely to, receive the confirmation for the same? And what does that then do to your overall numbers?
Yeah, so RBI committed to the guideline in the first quarter of conversion of SFB to universal bank, and while we are compliant with all the conditions that RBI has laid down in that scheme, the only thing which we are not compliant was the net NPA, which should be less than 1% for 2 previous years. Ours was about 1.15% or so. So the first quarter, the board took a decision that we will move the PCR from around 55-56% all the way to 70% at one shot, and that would then help us also bring the NNPA down to less than 1%, which has all been done. And so that now makes it comfortable from both the PCR and NNPA perspective. And we need to hold this for the next 2 years till March 26. And if you are able to hold it till March 26, then sometime in the calendar year 26 is when we should ideally be able to look at applying for the universal bank license. And if and when we do get that, there will be certain benefits that we definitely see, like the small finance being dropped from the name, the PSL target coming down from 75 to 40, and the capital adequacy going down from 15% to somewhere around 11%. These are the benefits. So basically, you can leverage maybe 1.5 to 2 times more because of capital adequacy going down. But from a business perspective, we got the AD1 license also recently from RBI, so that products of AD1 will get launched sometime in the second half of this year. So from a business perspective, even though we are a small finance bank, by and large, even after converting into a universal bank, our focus may still remain in the informal sector lending space on the lending side, because that's an area where we have created a large amount of capability over the last 15, 17 years. And
Right.
we are
Just
very strong in that segment.
we take that point. Just a final question then before we let you go, sir. A lot of the people then believe that because you have to maintain your PCR at above 70%, net NPO is below 1% for the next 2 years at least, that may have a bearing on your return on assets. That is likely to fall from 2% to about 1.5%. If you could finally give us a guidance on that, and we'll leave you.
Yeah. So basically, the question is the credit cost, which will be the impact on the ROA.
Both credit cost and ROA, yes.
Exactly. So on the credit cost side, we have earlier guided for a 1.25% credit cost for the full year. First quarter was 1.5%. If you remove that the one-time provision we made for the PCR, if you remove that, then on an ongoing basis, it would have been about 1.5% credit cost for the first quarter. The question is, how much will that be for the remaining part of the year? The seasonally weak first quarter is behind us, so we should look for better performance on collections for the next rest of the year. But as we have mentioned in our con call, by end of second quarter, we should be able to come back with a much clearer guidance on the credit cost. And along with that, we will come with a guidance on the ROAs also.
Okay, all right, Mr. Vasudevan, we look forward to chatting up with you as the quarter progresses. For the time being, we'll hold you to these numbers. Advanced growth of around 25%. You're sounding confident on asset quality, and we have to see things, how they progress with regard to the universal license. For the time being, we'll slip into a short break. Come back, continue our focus on markets and on individual stocks. Don't go anywhere.